Okay. All right. Welcome to Real Estate Hustlers podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. On this episode, we are talking with Karl. He's the managing partner of Auroras Investment Group. Karl is a real estate developer obsessed with growth. Karl's flipped himself out of the corporate job in the healthcare industry and is now focused on helping others make their money, work extremely hard through townhome construction and adding value to operational apartments. Karl, we're excited to have you here on our podcast. If you could just tell us a little bit more about yourself.
Excellent. I appreciate it. So I am based out of Seattle, Washington. And, right now we're, again, super focused on the townhome development. We just completed one project here in infill Seattle and just closed on another 30-unit apartment in Washington State as well, where that's a pretty heavy lift from a value add standpoint. And we've grown up flipping homes, like you mentioned, grown up flipping homes. Really got a lot of construction experience through that, but again, before that, a lot of experience in the corporate strategy space, business development, where I worked a lot with physician groups and hospital executives and changing reimbursement model, meaning how they got reimbursed or how they got paid. So a lot of taking really, really complex ideas, complex problems and boiling them down and getting them simplified and getting a solution based up or built up for these physician groups and hospitals.
Nice. That's huge. So you know how to take some sort of a problem and create a solution out of it to where everybody wins.
Yeah, exactly. And typically, most of these problems that the physicians and hospitals were facing weren't anything straightforward or weren't something that you can just take out of off of the shelf and essentially plug and play. Most of it was working with doing a string of pearls, so working with a number of different technology and services and putting them together, stringing them together, and coming up with, again, one solution, one option that those groups could implement, and we could help support them on the back end as well.
Nice. That's from one extreme to the other. I say that because you've got a nice, solid, comfortable corporate job, most likely paying you accordingly. What made you want to get started in real estate?
Sure. So I took the trifecta, the worst timing ever. So what initially started me in the real estate space was realizing that my salary was tied to my performance, not only my performance, but the performance of the company that I was working for. And most times you'd work, and it would usually be 12 to 18 months after your work that you would be compensated, whether through a bonus, a promotion, an additional staff to help you with some of your delegations, et cetera. Whereas from a real estate perspective, one thing that I was taught and learned early on was that, again, it's a lot of, I wouldn't say necessarily instant gratification, but these are tangible assets that we're building, we're putting together, and that we can feel the fruits of our labor on a much quicker basis. Now, again, by no means is real estate a get rich quick idea. It's a marathon, certainly is, but again, it's something where you can start stacking the dominoes, stacking the cards, and start seeing the fruits of your labor on a much quicker, much more realistic basis. And one thing I failed to mention is I started this journey about 5 years ago. So 5 years ago started the education process. My first flip was started 4 years ago, and I've now been full-time investing for 2 years.
So you started in residential, flipping houses, and what made you want to get into commercial?
Scale. So scalability. Absolutely. So again, knowing the lifestyle, creating the lifestyle that I wanted, or rather creating the roadmap of the lifestyle that I wanted. Flipping homes, the amount of stress, the amount of effort putting into each single flip versus the output versus what I was getting on the back end was severely skewed. It was trading time for money. Whereas the idea of commercial real estate, owning cash flowing assets, owning rentals, was kind of the antithesis, or kind of the opposite, where you'd stack these large multifamily complexes, you'd collect cash flow as a passive investor. Obviously, as an active investor, it's a little bit different, but still, nonetheless, the concept is still there, where you're able to get this passive cash flow and also tie in additional active investment.
Absolutely. And it definitely on the active operator side, it's a lot more intense. You are dealing with the day-to-day things, and you have to. I mean, there's a misconception that real estate is a passive investment and you make money in your sleep. While that can be true, at the same time, it's still a business.
Right.
It's still something you have to dedicate time to, and really just keep the grass trimmed in order to keep it as a successful piece of real estate. And I say that keep the grass trimmed, I mean expenses trimmed. You'll get there's constantly things that creep up, and the unknowingly things that come up. So
Right. Absolutely.
but why is operating within your passion important to sustainable success?
I think operating within our passion really allows us to put the most emphasis, or put, whenever you talk with an investor, whenever you talk with somebody that's interested in placing capital, the first orientation, or the first engagement is going to be learning more so about the operator, learning more so about the individual. And you can always tell when you're speaking with somebody who's passionate, not only about the investment opportunity or about investing in general. You can really feel the sense of passion. And generally speaking, you want to invest, or you want to do work, or you want to partner with somebody who's passionate about the subjects that they're working in, that they're running, the company that they're running, right? If you were to choose to invest with somebody who would only just spit out numbers, data, charts in a very monotone and a very unalive way, as opposed to somebody who speaks the business, speaks the business plan, how we're going to transform this. There's certain words and certain phrases that really excite people. And I think typically, again, it's the passion that drives the operator, passion that drives the person that's running the business, to really portray the true value, the true value of the opportunity, whether, again, it's an investment itself or the business itself.
Yeah, no, I totally agree. And you can tell just by the commitment of the project how well they speak on it. And then that really goes with experience. If they're confident in executing the business plan, that confidence comes through the words, from the passion, and how committed they are to making sure that they see it all the way through to the end. Just being
absolutely
a sink or swim captain. So it's totally agree with you. Active versus passive investing, which is right for you? So I asked this, how can one tell? How can one decipher between one?
Sure. So I would look at what you enjoy doing, right? Is it flipping a home? Is it taking an apartment from current operations into a new operations? Or maybe the antithesis is it really truly drawing of contracts? Is it working with physicians? Is it being an actual physician, right? Again, this goes back to identifying and truly understanding what your passion is, and then operating within that mode. Because if your passion is to be a physician, if your passion is to help others through medicine, or something of that nature, really, again, you can't. It's going to be a lot harder to be an active investor if your passion lies within practicing medicine. And so I think that's the question that you would have to ask yourself in order to identify whether you're best suited, or whether you're going to be most fulfilled within a active or a passive role. Is, again, what's your passion? Why are you doing what you're doing? And you don't necessarily need to be an active investor in order to use real estate to grow your wealth.
Yeah, totally, absolutely. And you still get the same benefits being passive. You still get your K1, you still get your tax depreciation.
Right.
You just don't have the tenants, termites, and toilets to deal with. So it's one or the other. But how do you manage real estate development in a market where commodity prices are volatile, like we're at right now?
Oh, it was really tough. So things have, since the pandemic, have leveled out. But we ran, I want to say 3 or 4 different developments during the height of the pandemic. So we were running into the cost of lumber more than doubling overnight.
Oh yeah.
Where a townhome project was slotted to be roughly $70,000 of lumber, turns out to be $125,000, $130,000. And then that just trickled down. Not only was it the cost that inflated, but it was also the delivery time that inflated a lot of different supplies. And so, to answer your question, I think the one thing that we used well in order to kind of counterbalance or counteract those rising commodity costs were guaranteed max price contracts with our developers.
Nice.
And we would provide allowances for skyrocketing commodities, or maybe even specific carve outs for some of those things. And so, some of the commodities again that we knew were coming up, we knew that were coming up. So we would do some kind of strike price. We would go under contract with the contractor on October 1st. That's when our strike price on lumber would be, and we would allow up to a 20% commodity price increase. Anything above that would be eaten essentially by the contractor. So I think ways like that, just creative contracting with your general, were certainly ways that we used to mitigate the risk as it comes to rising commodity prices. Obviously, timing, we couldn't really do much as glass and windows and things of that nature were their supply chain was just so burdened. There's nothing really that you can do there other than try and plan ahead and try and be ahead. So one way that we did that was we actually ended up renting a storage unit nearby, buying the windows months before we were ready for them, and storing them in a storage locker. Now, obviously, there's danger in doing that in terms of shipping and handling, but in our opinion, it was worth the risk.
Yeah.
And it was.
Yeah, for sure. It's one way or the other. One was going to be riskier not to do it. I'm with you. And now there's always something happening on to kind of balance out the scale. Now it's interest rates. How are you underwriting your risk premium on your multifamily deals right now?
That is a great question. So how we're doing and how we're handling interest rates is, especially leading up into next week, we saw January, what is it, 23 now, January 2023, just being a wild consumer increase. I was listening to an asset management podcast this morning about how January 2023 may have not been so seasonally adjusted. There were a lot of different impacts that could have actually made December much lower than what we anticipated it, which it was, which made, again, January's upswing feel significantly worse. So now we're going into next week, 50 or 25 bips. My thought is on the 50, unfortunately. And I think we've got a long way ahead of us in terms of where we're going on the interest rates. But to answer your question, how are we mitigating? How are we underwriting the risk premium? We're doing a couple things. We're adding 50 basis points to whatever we're going into it, even if we're getting a rate lock. So the deal has to make sense with a 50 basis point increase above what today's rates are, even if we're getting a rate lock. Why? Because we saw in November, December last year, a lot of other operators get their loans retraded by the lender at the signing table, essentially.
Yeah.
And so that made operators go into a tailspin of, well, what do we do? Right? What do we do? Do we fund it? Do we not fund it? Does it make sense, or do we just back out? Ideally, those operators had finance contingencies, but some obviously may not have.
Yeah.
And so that's the other way that we're doing it, is we're ensuring we have some finance contingency tied to it, and we want to be able to close within less than a week after we waive the finance contingency.
Are you looking for like bridge debt with a rate cap, or just out of the gates something long term?
Good question. No bridge debt. Right now we're working with local credit unions and banks to get usually about a 5 to 7 year. So ideally it's no less than 5. 7 years is better.
Yeah, that's a match. We're juggling between the two. There's on a project. It's all about the project too. If you've got finances that are, I'm going to call them junk from the current ownership, it's hard to. You got to sell your experience. You got to have a proven track record, proven history to really get something that's like a long-term debt out of the gates versus having to restabilize the project.
Right.
So it's But yeah, it's very expensive doing one way, or it's a lot more tolerable to do it through the bank, through the credit unions right now, especially.
Yeah, I mean, I think finding things that require bridge debt just have me really nervous at this point. Um, you know, if there's a deal that requires bridge debt and I can't make it a seller finance deal or some kind of seller carryback, then I don't even know that I would personally take on that project.
Yeah, yeah, it's got to balance, got to make sense. I totally agree.
I'm sure from a reward standpoint, there's plenty of deals out there that have the asymmetrical reward to risk profile, but unless it does have that, again, asymmetrical high reward versus low risk, like one that we're looking at right now in Seattle, that we're looking at assigning permitted townhome lots that come with the acquisition of the apartments, where we can go in and we can drastically reduce our cost basis in the apartments by assigning off those townhomes before we even get to the closing table.
Yeah, that's creative, and that's what it takes. That's huge.
Yep.
So I got a bonus question. If somebody's wanting to get into real estate, they know that they love the concept of real estate, but wanting to get into it full steam ahead as an operator, how would you recommend them to get started?
So the question is, started from the very beginning, or is this like?
Yeah, they're connecting the dots right now. They're listening to this podcast. They don't exactly know. They're figuring out what real estate investing is and how to do it professionally. How would you recommend them to keep down a path?
I think the very, very first step, especially if I were to go back and tell myself this, I would say house hacking is the number one thing to do. Reduce your cost basis, understand how to manage a rental, understand some basis of tenant landlord laws in a low risk way. The lowest risk way I can see is via a house hack. Why? Because you can get the best debt, i.e. homeowner debt, and you can do it with having a tenant pay for a portion of your mortgage, possibly more than one tenant, and you can have your entire mortgage paid. So I think that's certainly the safest way, lowest risk, highest reward. Again, kind of asymmetrical risk reward profile there. I think flipping is absolutely the last place I would recommend. I think development is the last place I would recommend to start off in. I think that there's, specifically in Seattle, we've got some interesting stuff on the development side, building backyard cottages, which is a really, really interesting play that we're working on right now.
Okay. What is that about? If you could elaborate just a little bit, backyard cottages.
Sure. So backyard cottages in city of Seattle, and I'm sure many other cities, not only in the state, but also nationally, allow for, it's called a detached accessory dwelling unit. Short is DADU. And these DADUs we are allowed in Seattle to be built up to 1,000 livable square feet, which, depending on where you live in the country, if you live in Texas, 1,000 square feet is probably your dining room. If you live in lower Manhattan, that's probably like a penthouse. So perspective, right? Keep that into perspective. But you can build these 1,000 square foot lots now on essentially any lot that's 5,000 square feet or larger in the city of Seattle. Additionally, you can build a smaller detached DADU on smaller lots, but let's say 5,000 square foot lot. You can build a 1,000 square foot DADU in addition to the main home. Now, oh wow, that's cool. But what's really cool about it is Washington State and the city of Seattle specifically allow for that DADU to be separately parceled.
Oh wow!
Via a condominium, converting your property into a condominium or being governed by an HOA, and then with that, you can do a couple things. You can get separate financing. So you can have a brand new DADU, $350,000 cost basis, appraised for $650,000, $700,000 pretty easily. And you can have separate financing. You could sell off one of the units. You can sell off both the units separately together. So there's a ton of flexibility with it. Great way to bump equity, great way to increase cash flow. Right now, we've got a project that we are 100% cashed out of it. We've got $340,000 loan on it, appraised at these are real numbers, appraised at $650,000. So we've got, what is that, about a $300,000 equity bump on that?
Wow, that's
No,
1,000 square foot.
yeah, no cash in, and it cash flows $500 a month right now.
Nice, that's incredible.
Took
That's
us a little bit less than a year, from raw dirt to placing a tenant. Actually,
Wow.
yeah, less than a year.
That's huge. That's what it's about.
Yeah.
So on getting the real estate investor, if he wants to take the journey, you'd recommend him doing a house hack, 3.5% FHA down, learn the tenant laws, learn how to work, how to manage the building, asset management. Any other nuggets to give out there?
I would say I would continue on the realm of multifamily on that, right? Just looking at ways that you can get appreciating land where it's got where it's got an asset that pays for its expenses. So again, whether that's multifamily, industrial, any other asset type, but trying to figure out how do you get the best price, i.e. looking for sellers that may be highly motivated, that might have been on the market for longer than expected. And of course, remembering to underwrite that risk premium in there that we talked about earlier, and really identifying these opportunities where you can be creative, you can creatively increase the value in it. Maybe it's got some extra land, you can do the development of it. Maybe you just short plat it and sell it to another developer. Maybe you short plat, develop, and add permits to it and sell it to a developer. Just figuring out what's the easiest, lowest path of resistance way to increase value on your real estate.
Nice, perfect. If we've got a listener out there that wants to get a hold of you, have some questions, how can they contact you?
I love working with people on LinkedIn. LinkedIn is my preferred platform, or my platform of choice rather, to engage with listeners. It is LinkedIn. You can look me up at Karl Krauskopf. It is, I think that I'm the only one on LinkedIn as Karl Krauskopf. I should look that up, but yeah, LinkedIn is a great space. Perfect. We have an investment group. Excuse me. We have a Instagram at Auroras Investment Group, as well as our website, aurorasinvestmentgroup.com.
Awesome. And then when we rebroadcast this out, we'll have your contact information in there as well.
Love it.
True pleasure having you on today. Appreciate it. And I'll definitely look forward to talking to you in the future.
Likewise. Thanks, Josh.
All right. Thank you. Bye.